Well, good morning. We're so thankful for each of you being able to join us on this quick webinar today. Uh, Obviously, these are interesting times, and a lot has been shown in television, radio, you name it, with regards to tariffs and their effects on the markets, and most importantly, their effects on our clients here at Kill Point. So we're very fortunate to have this time to be able to get with you and to share with you some of our thoughts. We're also very fortunate to have Dr. Steve Skanke, our Chief Economic Advisor, on this call, who works tirelessly with our investment team in order to make sure that we align things properly given whatever the environment is. My name is Robert Mays. I'm the CEO of the company here at Kill Point. Very fortunate to be here. And Steve, just to let you guys know, Steve, this is right in his alley because he teaches international affairs and economics. He served in 4 different administrations. Probably has seen things not quite like this, but maybe with some similarities. And with that, I would like to ask Steve, here we are, we have tariffs. We've been hearing about these for quite some time. Give us a lay of the land of what this looks like, both in terms of the economics of it, but also the international relational component of it as well.
Yeah, thank you, Robert. It's historic, at least in the lifetimes of all of us. The last time we had extraordinary tariffs were in the 1930s, that in part precipitated the economic troubles that we had there. But as you asked first, just a word about what they are. President Trump has imposed a 10% across the board tariff on all goods coming into the country from all places. In addition, last Wednesday, he announced reciprocal tariffs on 59 different countries, interestingly, including some that don't have any significant population. And this was calculated by a formula that has certainly raised a lot of questions, but it's resulted in tariffs of significant magnitude on a number of countries, and in particular some that were targeted for that purpose. So tariffs that effectively are at 40 or 50 or even 60% of the value of those goods coming into the United States, which means that products from those countries, as they arrive in the United States, would have a tariff of or a tax on the value of the good of that amount. Now, certain products are excluded. Some have specific tariffs. In some cases, they don't apply to pharmaceuticals or energy yet. Mostly it targets Europe and Asia, not so much in the Americas, though interestingly, Brazil was targeted, even though the United States has a trade surplus. That is, we sell them more than we buy from them. But to put it in context, it's the highest tariff since the 1870s. If they stick as currently imposed, it's the largest tax increase since 1968. For any of you who will remember, President Lyndon Johnson imposed taxes, income taxes, and income surtaxes to help pay for the war in Vietnam. What are they, what are they about? Well, the president has given us a number of goals, and I proceed with the belief that he is trying to do what he thinks is right for America. And he said several different things, Robert. One is that He wants to remake the global order. He wants to stop the way the U.S. has been taken advantage of. He wants to return to a golden age that he characterizes as in the late 1800s. He does say that he wants to return manufacturing jobs to the United States. So, as we know, we have evolved over the last 70 years from being more of a manufacturing country to more of a service country. And what we've seen is services, including financial services, banking, investing, software, technology, that creates a lot of high-paying jobs that where America has flourished. And of course, this hasn't been calculated in the application of tariffs because they've looked primarily at goods. He also wants to provide, he says, an alternative source of income. As he points out, we went from a tariff income based economy to an income tax income country because tariffs just wouldn't support the size of government. And as we first got into World War I and needed to fund our country, and then later as other government programs expanded to reflect the size and the development of the U.S., additional revenues were needed. President, as we know, would like to extend his 2017 tax cuts, and to do that costs about $4.5 trillion over 10 years. And he'd also like to provide some additional tax cuts on corporations, taxes, I'm sorry, tips, Social Security income, overtime income, and all of those cost an additional amount, and so he has some expectation of being able to do that with tariff revenue. Whether that'll be enough remains to be seen. He'd also like to reduce the deficit, ultimately pay down the debt, which is admirable if that can happen. Um, so that's sort of what they are, and what his goals are. How do they affect the economy and markets? Well, I mean, the first thing that they do, as you would expect, because they are a tax, they reduce consumer and investor funds to spend and invest in new things. So they're going to slow economic growth. That probably results in some increased unemployment. They're also going to increase prices. Which raises inflation. So we've heard the word stagflation. Last time we dealt with stagflation was in the 1970s, where we had increasing prices and slowing economic growth and rising unemployment. And President Reagan was elected when the so-called misery index of the unemployment rate and the inflation rate was well into double digits, and we had a change in administration. Um, and so, one of the questions is, are we going to see stagflation again? Because by definition, that increases the misery index. On companies, it lowers earnings because it increased the cost of doing business. And of course, that then lowers stock prices. So when we ask, well, what are the risks? The risks are that it becomes punitive to the economy, to consumers, and to investors. Um, we had in the first Trump administration tariffs that were imposed primarily against China on furniture, steel, appliances, and the impact there was that it was a one-for-one pass-through of the tariffs to higher prices paid by American businesses and um, consumers. The other big risk, and we saw the market down basically another 5% on Friday when China retaliated. So there's a risk that there will be retaliation. And although China's retaliation was not so much on services, but the United States exports a lot of services, and that supports a lot of jobs, and we could get that too. Um, and then the other big risk, and we've seen it show up already. Just yesterday, the um, small business optimism index came down. Consumer confidence and consumer sentiment has come down. And when those things happen, companies stop hiring, they stop investing, consumers stop spending. Um, there was a notion mentioned by the Treasury Secretary that the top 10% of American uh, household incomes own 80% of the stocks. And while that is true, 42% of all households are invested in the stock market, and 62% of American households own stocks through their retirement plans. And we've seen a lot of concern and angst expressed about, do I need to delay my retirement? Will I have enough in retirement? And so we've seen people concerned, starting to think they need to pull back to conserve what they have, and so those are certainly concerns and risks that we see arising from these tariffs.
Hmm. Thank you, Steve. And I just want to let the audience know that we do have some questions coming in, and hopefully we'll have enough time to get to these. So if you do have a question, please send it to us, and we'll do our very best to answer it during this webinar. Steve, you really bring up, I mean, it's one thing kind of talk economics, but I love the way that you brought in the risk component, because ultimately it's where the rubber meets the road, and it's individuals, it's households, it's business owners. Uh, how do you see the effect of these tariffs, particularly on businesses? As we well know, China is actually targeting specific companies to potentially go after. We know a lot of companies here in the U.S., because of parts and whatnot, are going to be affected. And then, as you said, just retirement assets of individuals. There's no doubt that everyone is being affected by this to some degree. So how do you see this occurring right now with businesses and individuals?
Well, Robert, that's just really sort of the nub of what what we're concerned about here. But I'd like to start by shining maybe a better light on what is a terrifying and troubling situation. The reality is that the U.S. economy came to the end of 2024 with very positive growth. Economy grew at 2.5% in 2024. No recession. Inflation was at 2.5%, heading to 2. The unemployment rate was at 4.1%, which when you look at folks in transition, is a very low rate of unemployment. There were more job vacancies than there were people looking for work. But to put context around it, the tariffs, the expectation now is based on what's been done, is that growth is going to slow from 2.5% to 1.5%. First quarter growth actually might be negative. Part of that is because of the increase in the trade deficit, and part of that is going to be the trade deficits increased because folks have bought before the tariffs came into effect, and because of the retaliation, um, some exports were already reduced. So we're going to see a scary number for first quarter GDP growth, I believe. Uh, the recession probability has gone from 0 to sort of 50 to 60% chance in terms of what folks are concerned about. We hope that that doesn't happen. Uh, Inflation, uh, year-end target for last year was it was 2.6, going toward 2. It now looks like it's going to be 4% or higher, and the unemployment rate is just going to climb. Um, and an interesting thing, Robert, just again to put context around it, we had very difficult inflation beginning in 2021, 2022. But through that period of price increases, we were fortunate that wages on average increased by more than price increases. What'll be different this time, because of the tariffs, is that wages have started to slow down and are probably not going to be going up as fast as prices. The other thing, and to the point of your question, is we've experienced S&P 500 or general corporate earnings growth in the double digits, between 12 and 14%. Last year it was 14%. This year, the projection for corporate earnings growth at the beginning of the year was 14% for 2025. The latest estimate, just with the preliminary imposition of these tariffs, is that's going to be about 7%. And you can support high and growing stock prices. The S&P was up last year about 25% all in, including dividends. And people, expressed concern about that. But with 14% earnings growth, that works. Doesn't work so well with 7% earnings growth. The other thing is we've had artificial intelligence driving positive productivity growth in the United States. What we saw with the imposition of the tariffs is that the companies that are doing that, Apple, Microsoft, NVIDIA, Google, um, are challenged by these tariffs because so much of their intermediate goods and services come from overseas. Uh, so, as I mentioned before, we're concerned about stagflation. We're concerned about the disruption to economic alliances, and concerned about deficits pushing interest rates higher. So those are, I mean, it's a good start. We're starting in a good place, but we certainly have these challenges. The other thing I just mentioned is when we look at this left-hand column, this shows consumer balance sheets, total assets of Americans, individuals, has grown to 190 trillion. It's the highest it's ever been in our history. And so when folks talk about the golden age or going back to the golden age, this is the golden age. And of course, that causes folks to scratch their heads as to what is the real motivation of the tariffs, because it's never been better than it was up until a couple of weeks ago. Um, we talk about the S&P 500. This just shows what happened through last Friday. The green line on the left is the Magnificent Seven, the big companies, which includes the ones that I mentioned, and Tesla. Year to date, they're down 23%. The other 493 and the S&P 500 are down 6.2%, and which is half of what the S&P did overall. That's actually helpful to see that while there's been a sell down in those technology companies that I mentioned, and that is important and a cause for concern. The other companies, the other 493 in that part of the economy are doing more or less okay. And then just the last thing that I think is always helpful to keep in mind when we say, well, like, who are the winners and losers? What does the stock market mean for this? Is on average, the S&P goes down within any individual year by 14%. And even though annual returns are positive in 34 out of 45, so more or less 75% of the time. And we look at 2023, where the S&P was up 24%, prices were up 24%, even though they were down 10% during the year. Same with 2024, down 8%, but closed the year up 2023. And so what do we have so far this year? Well, down 17% during the year, and currently down 14, but certainly has the ability to turn around and come back. That's what we're looking and hoping to have happen. Because otherwise, the increase in the cost of living, I mean, the cost of living for Americans as a result of the tariffs as they are right now is about 2.3, 2.4%, which on average is about $3,800 per household. For higher income households, that goes up to about 10,000. And that just weighs on all of us, particularly if incomes are not going up. And all of this just goes back to the tariffs. Now, the president has been clear that there's going to be some cost in the effort to what he's trying to do. I think a lot of folks, our clients, others, have been surprised by how quickly the cost is coming to them. And that's, that's part of it. Now the tariff revenue, there have been some concern that it's paid disproportionately by middle and lower income groups. And if it's used to fund the extension of the 2017 tax cuts that favored disproportionately higher income groups with a reduction in capital gains tax and reduction in the top rates, that actually represents a transfer from lower income to higher income groups, and significantly from the president's base. So, on the political side of things, president, if this is his plan, is right to move as quickly as he can, because the political support for this will wither away pretty quickly as it shows up as basically a pay cut for all of us as quickly as sort of starting tomorrow.
Right. Yeah, thank you, Steve. And I think I hear you say that when you were talking about household net worth, first of all, it's dramatic to see how little the liabilities of households were versus the assets component of it. Wage growth, all these things. There's a lack of, if you think about other markets that typically have topped and starting to have corrections, there's usually exuberance in the market. People kind of thrown out, the whole risk idea, thinking that this is going to be automatic, it's going to go up. We don't have those elements in this. This is very much has occurred over a fiscal policy decision, and we're right in the midst of it. We just have 5 minutes left, and so I want to get to which really hits on some of the questions that are coming through, and that is individual portfolios. We work hard here at Kill Point to with advisors, with the investment team, and with you in particular to look at what that environment looks like, what is the appropriate risk for each family that we're investing on behalf to help them meet their goals. Uh, any thoughts that you would like to share on what that process looks like or what we're doing in particular right now?
Yeah, thanks, Robert. And that's one of the reasons we're doing the webinar today, so that we can share with a larger number of our families uh, how their portfolios stand, and how to think about what is a difficult situation for the economy and for financial markets, at least in this interim period. Um, First, I would say, and we do get a lot of questions about what do we need to do next. First, I would say that a lot of the things that one might think need to be done next really have already been done. We build portfolios to help families achieve goals, and they are risk-based, risk diversified, so that when things like this come along, and it doesn't have to be exactly what we have now, but think about a pandemic, think about fighting in inflation, think about other geopolitical events, the great financial crisis that we had in the mid 2000s, from 2007 to 2009. Through all of that, stock prices have increased on average 10% a year over time. But to be able to achieve that, you need to have a portfolio that allows you to live through these crises and not have to be selling investment assets, risk assets, stocks, um, to cover your family goals. That you can ride through these, and that you have the defensive side of your portfolios to help you through that. And when we look at our portfolios, and obviously we never like it when the markets are down and portfolios are down, but because of the diversification that we do and that people need to be doing, our portfolios have actually held up very well, certainly against their benchmark. We've had a tilt toward value, which is less vulnerable to stocks being down. We've rebalanced along the way to take gains and put them back into defensive assets. Last year, we added duration, which means that we moved from shorter term to longer term fixed income bonds, which have done very well as we've had this tariff crisis. Um, we've started to do that again as the 10-year Treasury bounced from below 4%, 3.95% up to almost close to 4.5% again, to capture that. And just as to that's quite likely, Robert, a result of China selling part of the big cash of treasuries that they own. Um, and the defensive side generally in our portfolios have outperformed their benchmark because of the diversification, in some cases alternatives, but also to gold, which is across our platform in our model portfolios. And it's those things that help provide the stability and the balance uh, that that can give us confidence and help us have confidence that we can weather through this. If for those who are on the webinar who aren't part of what Keel Point uh, does for its clients, those are important things to keep in mind. To have a plan, to have it diversified, to be looking at the defensive as well as the risk assets that just allows us to do that.
Thank you, Steve. We're at the bottom of the hour, so unfortunately, there's so much that we could talk about, and I think we've answered some of these questions. However, through what Steve has shared, with those that weren't addressed, we will make sure that we get answers to you. What I want you to take is hopefully you walk away not just simply with maybe a better, broader understanding of what tariffs are, but just how we work internally within this organization for your behalf. As Steve said, most important thing is goals-based, risk-appropriate investing. That's what we focus on more. And when clients historically have stayed the course with those plans that have been established through you and your advisor, they're positioned to do well. And I'm like Steve. I mean, I don't like to look at my accounts and see them down in value at all, and it's not a comfortable feeling. But do know that we are here working very diligently on your behalf to look at all of these things and to make sure that we are doing our best to position you for success with your financial plans. If there are any participants that joined this webinar that are not clients of Keel Point, first of all, thank you for joining. Hopefully, this was helpful to you. And if you were interested in knowing more about our firm or meeting with an advisor, please reach out to us, and we would love to have a conversation with you with regards to that. Thank you, everyone, for the call. Thank you for putting your trust in us. We are reminded that we want to earn that every single day. And so we're very grateful for that. We're grateful for you as clients. And again, on behalf of Steve and myself and everyone here at Keel Point, we thank you and wish you a wonderful day. God bless. Bye-bye.